We're joined now on the show by Prakriti Sofat, who is a regional economist at Barclays Capital. She joins us on the show from Singapore. Now, Prakriti, to begin with, what are your growth and inflation targets for the region and India also in the year 2012? When do you see a pickup in the investment cycle here in India?
Well, for the region, we are looking for economic growth to slow in 2012 to about 6.8% from 7.4% last year. So sort of a shallow slowdown, largely, of course, driven by the main economies in the region, which is China and India. On inflation as well, I think it's worth highlighting that we are looking for inflation to moderate across the region. Base effects obviously are going to be favorable in the first couple of months of the year, but also economic growth in the region is slowing down, suggesting that inflationary pressures are gradually abating. The risk, of course, remain from commodity prices, which continue to remain elevated, especially oil prices. In India's case, we are looking for economic growth of about 7% for the fiscal year 11-12, now matching the RBI's new target, which they revised down from 7.6 to 7% as well. On the inflationary front, I think it's fair to say that inflation continues to remain sticky in India. We're looking for WPI to come to about 7% by March.
Right, and Prakriti, what's the view on Indian government securities? Do you believe it's a good opportunity to be buying into it?
Yes, we have been recommending long the Indian bond markets, and we continue to do the same. In the medium term, of course, the rate cuts, which perhaps would materialize in March, April, would support the curve itself. But I think it's also fair to say that going into March, there is going to be a demand from banks as well. And the OMOs from the RBI would also continue to help the market.
Hi Prakriti, afternoon. Now the CRR cut undertaken by the RBI was timely and expected. But going forward, what's your expectation from the rate cycle here in India over the next 1 year?
Well, if you look at the liquidity condition, clearly it still remains structurally in deficit. So we think there's perhaps likelihood that the RBI would cut the CRR again by 50 basis points in March. In terms of the policy outlook, I think it's a balancing act between slowing economic growth, but at the same time, as the RBI pointed out, non-food manufacturing inflation still remains fairly sticky. So we think that in the near term, perhaps March or April, the RBI would cut interest rates by 25 basis points, and currently our base case is for a cumulative 75 basis points through the calendar year 2012.
And what's the Barclays view on the Indian rupee and the appreciation that we've seen so far? Do you believe that there's more strength in the rupee, and what are your targets?
Well, the rupee obviously rallied in the month of January when we've seen a global risk on, which was to be expected given that it was massively underperformer at the end of 2011. Going forward, we remain conservative on our targets. Our 6-month target is 49 and 12-month 48 for the Indian rupee. Of course, the risks remain that it could perhaps be weaker if the European situation deteriorates from here on.
Now, Prakriti, opinion is divided as to whether we will see a QE3 come out of the US or not. What's your own sense in the backdrop of stable economic data coming out of the US?
But I think that's fair to say economic data out of the U.S. has been surprising on the upside. You know, ISM, we look at the labor report as well on Friday. But I think in terms of QE, our base case is not a QE3, but I think the risks are definitely there. We would attach roughly at least a 40 to 45% probability that you could see a QE3, because at the end of the day, when you see rhetoric from Chairman Bernanke, it still remains fairly dovish, indicating that if unemployment remains fairly elevated, then there is room for further policy easing in the U.S.
And what could a likely QE mean for the US dollar, which did see a strong rally last year? And also, what would it mean for US treasuries, where yields are at an all-time low?
Well, I think for the dollar, if you look back to the experience of both QE1 and QE2, it was quite evident that the dollar did come under pressure, and I think we could expect some sort of, some sort of weakness in the currency. But I guess it's fair to say that when you look at crosses such as euro dollar or GBP versus dollar, it's very important what's happening in both the economies. And here I think our view is very clear. From a growth perspective, clearly the US is going to outperform the Eurozone, and we continue to expect the euro dollar to weaken to about 1.20 in 12 months' time.
And given that the global situation, the uncertainties just seem to loom large in the Euro region, the EU summit indicated that Greece might be getting into a situation of a messy default. Does that reduce the amount of risk you're willing to take over the next few months?
Well, I think in terms of uncertainty, obviously it remains extremely elevated, like you pointed out. There's no immediate and clear solution, coming together for Europe. But I think it's fair to say that, if you look at positioning, if you look at valuations, there is attractive opportunities across the board. We think that there's still value in emerging markets, and we would try to take exposure to countries which have strong fundamentals and also which have a closer link to China, because there it seems to be that we are getting a soft landing.
And finally, Prakriti, give us your view on the outlook for the euro over the next 12 months.
Sure. For euro, I think it's fair to say that, in the first couple of weeks of 2012, we did see a strong rally in the euro dollar, given it was a risk-on environment. But we're not really sure whether that's going to be sustainable in the medium term. We continue to look for the euro dollar to drift down to about 125 in 6 months and about 120 in 12 months time, largely driven by the fact that, first, growth differentials are going to be in favor of the U.S. economy. We're looking for 2.5% growth versus a contraction of nearly 0.3% in the Eurozone in 2012. And second, also from a policy perspective, our base case is that there is not going to be a QE3, and clearly monetary policy is going to continue to be eased in the Eurozone. We expect the ECB to cut interest rates again in March, suggesting that the euro dollar is going to be drifting further lower to 120 by the end of 2012.